Good afternoon, everyone, and welcome to this month's webinar, Insurance Planning for Clients in Their 40s. Today's presentation will last about 50 minutes. During that time, if you have questions as we go along, feel free to ask them on screen, and we'll do our best to answer them timely. And then at the end of the presentation, we'll open the phone lines for verbal questions as you raise your hands on screen. This webinar is being recorded and will be posted to our website within a week. Regarding CFPCEs, if you are logged into the webinar today for more than 50 minutes using the email address you registered with, we will report your attendance to the CFP board. That process can take up to a month. Our webinars this year focus on the different types of insurance that are recommended for your clients throughout their lives, focusing on one couple, Sam and Sally, as they age. This month, they're in their 40s. From now until the end of the year, we'll follow them through to the end of their policies and the end of their lives. Please keep in mind that while we're recommending specific types of insurance coverage for specific points in Sam's and Sally's lives, these types of insurance are not exclusive to their age as presented, but rather a general idea as topics for presentation. Today's presenters will walk you through how critical care insurance can help your clients protect their income and the types of insurance protection available for your business owner clients, who may even be you. And now about your presenters. Kathy Copack came to Low Load in May of 2005. As a VP of our advisor services team, she works with advisors and their clients to tailor disability solutions that fit their individual needs. She's got a medical background which provides Low Load's clients and advisors with knowledge and expertise that's helpful when navigating the underwriting experience. Keith Maurer is known as Low Load's omnipotent insurance guru. His 40-plus years in the insurance industry have been spent researching and developing insurance products, marketing Low Load life insurance solutions, and now acting as a product distribution strategy consultant to several well-known insurance companies and as in-house consultant for you and your clients here at LLIS. To start us off today, please welcome Kathy Copack.
Thank you, Dina, and good afternoon, everyone. The plan for today is we're going to review business owners' clients and what we need to protect their business and their own personal disability. We're going to review a little bit more about retirement protection, and we're going to talk about critical care and the expanded uses of this particular product. We're going to touch on group life and find out why it's not all it's cracked up to be. And Keith is going to spend some time talking about key person and owning a business and setting up a buy-sell agreement. Last month, we designed an individual disability policy for Sam based upon his advisor's realization that he was underinsured for disability and also wasn't protecting his retirement. So now let's fast forward where Sam is now 45 years old. He's bought out a practice of another CPA. So not only does he have himself that he has to be worried about, he also has employees depending upon him. Therefore, his risk has changed and also has grown. This month, we will look at Sam's needs from a business owner's perspective and design a comprehensive multi-policy plan to protect his personal risk and his business. Now, this is a subject we touched on last month. What is your client's most valuable asset? We also know that the foundation of your planning is based upon your client's ability to earn an income. We help you protect your client's income in the event of a disability. Most of your clients probably know the importance of having homeowners insurance to protect their home, car insurance to protect their car, and health insurance in order to stay healthy. But a lot of them may not realize that there's disability insurance to protect their business income. If you were with us last month, we looked at a pyramid as Sam being a W-2 employee, and his income was his biggest asset. But now that Sam owns a CPA firm, his income is dependent upon the success of the business as well as his employees, thereby making his business his greatest asset. If you were not with us last month, you can view that webinar on the education pages of LLIS.com along with our other recent webinar presentations. So now let's take a look at a way to protect Sam's CPA business. The first is with business overhead insurance. The purpose of business overhead insurance is to keep the doors open while your client is recovering from a disability. What expenses are covered with business overhead insurance? Well, some examples are rent, taxes, insurance, employee payroll, and loans. What's not covered? Business owner's income. That's the purpose of individual disability. What does business overhead insurance cover? Well, in this example, we're using a business overhead amount of $30,000. Keep in mind that Sam's actual expenses to run his CPA practice on a monthly basis may exceed $30,000, but $30,000, but the actual expenses that he can be reimbursed for are things such as employee salaries, utilities, rent, equipment leases, loan payments, and business insurance. Disability planning for business owners. Well, the tax treatment, most people will ask, what is it? Well, the premiums can be deducted as a business expense, and when the benefits are received, even though they're considered taxable, since the benefits are used to pay business-related expenses that are tax deductible, it turns out to be a wash. Now let's go over what exactly business overhead insurance does. Well, the first thing it does is it helps the business owner meet their operating expenses. It helps to preserve the continuity of the business. It maintains goodwill not only with clients but as well as with his employees. And it helps retain the business value since revenue will be forthcoming if someone can run the business while the business owner is out on claim. Often when people think disability, they think it means that they'll never work again. But in most cases, that's not true. Most disability claims last just under 3 years and are residual claims and are not due to an injury, but more so due to an illness. So the business overhead expense insurance is designed to cover the business during the time that the business owner is out on claim. Now here's an example of Sam's business owner policy. Unlike regular individual disability, you do not want a short or you do not want a long elimination period. The bills are going to be coming in and we need to get them paid. So we generally look at a 30-day elimination period. We'll look at a benefit period between 1 and 2 years. And in this case, we've chosen 1 year, a 30-day elimination period. And again, we're going to use an example of $30,000 a month of reimbursable expenses. And if those of you who are familiar with long-term care, we call it a pool of benefits. Well, business overhead is very similar to that. You have a pool of money that's available, and it's a fluctuating amount that you can pay your expenses. So in this situation, he has $30,000 available to him every month, which is a total pool for a year of $360,000. But let's say his expenses in the first month don't equate to $30,000, but rather $20,000. Then he still has a pool of $340,000 of benefits still available for the remaining 11 months. And in this particular example, we're using loan protection. Loan protection means that if Sam has taken out a loan, let's say to build a new building, maybe to buy some equipment, and in order for him to make the payment on that loan, we've added a benefit which will pay the loan $500 per month. And for this particular plan, the annual premium is $4,310. So let's review. Sam's in a situation now where he's a self-employed CPA. His income last year, or the last month when we did him at 30, was $75,000 base and $5,000 bonus. You know, fast forward to age 45, he's now making $150,000 base and $150,000 in bonus. In addition, after purchasing the CPA practice, it came with 2 employees, a bookkeeper and an office manager. So we're going to take a look at the possibility of a multi-life plan for him and his employees. And like I mentioned on the pyramid a few slides ago, not only does Sam need to be concerned about protecting himself, he now has employees depending upon him and the success of his business. So again, we're looking at Sam. He's got $150,000 base and $150,000 bonus, which equates to $12,500 a month in salary and $12,500 a month in bonus. And the advisor was quick to review his disability plan and say, hey, look, I think we need to increase your monthly benefit now that you're making a lot more money. So what we decided to do was increase his coverage to $12,750 a month. So if he goes out on claim, that's what he would be getting tax-free. And the annual premium for that is $73.57. So this is his revised disability plan, and it includes COLA, the ONOC rider, and it also includes residual. And during the process of quoting the increased benefits for Sam, we decided to explore the possibility of a multi-life plan since he now has supporting staff. A multi-life plan allows employees from one business to be on a list bill for a similar insurance product, and it also provides unisex rates whereby if these were purchased individually, the female will be charged a higher rate. In addition, with a multi-life plan, the insureds are offered a 20% discount on the premium. Now keep in mind that when Sam bought the practice, these employees, the bookkeeper and the office manager, already had coverage in place. But he and his advisor recognized that they could possibly lower the cost of that coverage by still maintaining the protection for the valuable employees. So let's look at Sam. He now has individual coverage. It's costing $73.57. He has a 30-year-old bookkeeper who would be considered a 5A OC class, and he's paying that person $85,000. That person has a monthly benefit of $4,475, a benefit period of 5 years with residual. Keep in mind that residual is the most important rider you can have on a disability plan because it will allow that client to get paid benefits if they're working part-time. And the premium on this particular plan is $717 on an annual basis. And the office manager, who's 28, is considered a 3A OC class, and her income is $35,000 a year. She will get $1,000 of monthly benefits if she were to go out on claim, and she also has a 5-year benefit plan with residual, and her individual premium is $377. Now, it's important for you to know that if Sam didn't use a multi-life plan and got his 2 staff member individual policies, what the cost would be. So let's review. Sam's standalone policy for himself, which is providing him with a little over $12,000 a month in benefit, costs $7,357. Coverage for his 2 employees is $1,094, and for his business overhead insurance that will provide $30,000 a month in business overhead insurance costs $4,310 a year. So Sam's covering not only himself, his 2 employees, but he's also covering his business overhead. Well, that annual cost is $12,761. Well, we decided to, like I said, look at what a multi-life plan would look like, and when we looked at that, the savings came out to be in $2,484 because his annual premium dropped to $10,277 for all 3 of these plans. So in this case, he was saving so much money he couldn't afford not to move forward with a multi-life plan. Now I'm sure most of you think that well, maybe some of you think, but there are other options rather than just going with multi-life. Those of you might be familiar with a product called group disability insurance. And I bet most of you didn't know that we here at LLIS can provide you with a group disability plan. The purpose of this slide is to give you a brief review of the differences between them. So let's talk about how it's underwritten. Multi-life is fully underwritten, and it's available to 3 or more lives. With group disability, if you have 3 or 4 lives, there's health statements that they have to complete. So it's not fully underwritten, but there's about 3 or 4 questions that they're required to answer. When you have a group that's 5 to 9 lives, they do what is known as field underwriting. They're going to ask the employer, are they aware of any serious medical conditions of their employees? And then if they have 10 or more lives, they just ask the broker if you're aware of any serious medical conditions within the group. The rates with multi-life become unisex, where before they would be individually male or female. And because the plan is more comprehensive, the rates are going to be higher than if they were with a group disability plan. The rates for the rates for the group are going to be unisex, similar to the multi-life. There's going to be some fluctuation in the premium because it's based upon a census, and the census is the number of employees and how old they are and whether they're male or female. So the premium can obviously be lower because you have few riders and the coverage isn't as comprehensive. Now, are the rates guaranteed? Well, with a multi-life, yes. It's a non-cancelable and guaranteed renewable. And what that means, as long as the clients do not affect a change in the plan, there is no increase in the premium. And as long as they continue to pay the premium, the plan cannot be canceled unless they choose not to pay the premium and the policy lapses. On a group disability, the premium can fluctuate every 2 years, so it's not locked in for the life of the plan. With the multi-life, the convertibility option is not applicable, and it is portable because wherever you go, if your client changes from one employer to the other, with the multi-life plan, they can take that plan with them and they get to keep the discount on the plan. They don't lose it by leaving their employer. The convertibility option on a group disability depends upon the carrier and the particular plan that they have, and there is no portability option with most group disability plans. Okay, let's talk a little bit about group long-term disability. This is an actual case that I'm working on that an advisor referred me to. It's an actual CPA firm, as a matter of fact, and you can see the ages vary from age 30 to age 43. You can see the income there. And this particular plan pays 60% to $7,000 of monthly benefit. The benefit period goes to age 65. But it only has a 2-year own OC. And what that means is they're protected insofar as them being a CPA for the first 2 years that they're out on claim. After that, they would be required, if they're capable of doing something else, they would be asked to do something else. But if they can't do the substantial material duties of being a CPA, they will be protected for those first 2 years. And the premium on this runs about $167 a month or $2,004 annually. And it's a perfect example because we're working with people in this particular presentation that are in their 40s, and here we have individuals that are 45, 43, and 30. Now keep in mind that group plans usually work well with bigger groups that have a lot of young people, because the younger the people on the census, the lower the premium. Group doesn't work well when you have a very small group or a group with a high turnover, because as the employees age, the premium is going to go up. So again, there's going to be that fluctuation not only from month to month, but from year to year. Retirement protection, we talked about this last month, and I'm going to go over it again because I think it bears repeating. In this particular situation, Sam is making a lot more money, and I think it's really important that we make sure that we've covered retirement protection and the adverse effect it can have if you don't have this plan in place. Just to review, the annual limits for 2013 for a defined contribution plan is $51,000, and for a 401k or a 403b, it's $17,500. Now, just so you understand, the benefits are paid to a trust. It's not in cash. The funds are chosen at the time that the client goes on claim, which is usually about 180 days after the disability. The funds are managed by a trustee who's an independent trustee, not affiliated with the insurance company in any way, and it simulates a non-qualified plan. It is not a qualified plan. So the client is going to get a 1099 every year on any capital gains or interest that has been gained in those accounts, and he will continue to get that every year whether he's on claim or not. And the purpose of that is just to allow him, when he gets to retirement age, i.e. age 65, he'd be able to receive these benefits tax-free. So let's review. With Sam, what we looked at is a possibility of getting him disability coverage to replace his lost income, which we did. We were able to give him $12,750 of monthly benefit, which equates to about 51% of his income. We were also able to protect his future retirement income because he's contributing $15,000 a year in his 40. Wait a minute, did I go back? Yep, I skipped one, sorry. He is contributing $15,000 into his 401k, but if he should become disabled, there's no contribution going into his 401k. So the advisor recognized that we need to do something to protect this. So we told the advisor, well, we have a plan that could possibly protect his retirement contribution. So let's review. Again, $12,750 of monthly disability benefit, and the $15,000 benefit, we were able to secure $3,800 a month going into a trust, which is now 66% of his income. The premium for the $12,750 of monthly benefit cost $6,010. The annual premium for the retirement protection plan is $987, which is a total of $6,997, which if you take his annual income of $300,000, that's about a little less than 2% of his annual income. So for a little less than 2% of Sam's income, we can provide him with a disability plan that'll pay $12,750 a month, and he can be assured that $3,800 on a monthly basis will go into some sort of retirement plan that he and his advisor has picked out. These plans also include residual and the ONOC and the COLA rider. So let's recap. Sam's advisor was concerned that if he were to become disabled, he couldn't put money into a qualified plan or a retirement plan, which would mean he wouldn't be meeting his established goals. When we reviewed Sam's individual coverage with him and his advisor, we realized that he was underinsured because now he's making so much more money. Now, with the individual coverage, we were able to recalculate that, and we're now giving him $12,750 a month. The $15,000 that he was contributing to a qualified plan is now covered with the $3,800 a month. And if he has enough protection for both his earned income and his retirement contributions, and it's costing him less than 2% of his annual salary. So Sam may be like your typical small business client. What about those odd occupations or clients who have maxed out their disability coverage, or believe it or not, even clients who are not working, but they realize they need some additional coverage? Well, that's where critical care comes into place. If you recall, Sam is married to Sally, and Sally's been a teacher since graduating college. But now they've decided that Sally will take a few years off and stay home with their kids. So she's not currently earning an income, but what would happen if Sally were to become disabled? In addition to just getting her care that she needs, Sam would need to maintain his business and would also need to help with all the things that Sally normally does, things such as homework with the kids, driving them to their activities, cooking, cleaning, not to mention child care. All this can add up to a substantial sum of money. Enter critical care. Just to give you some background, critical care was developed in the early 1980s in South Africa by Marius Bernard, who's the brother of a famous heart transplant surgeon, Christian Bernard. They both noticed that patients would survive surgery but would not thrive very long after, and this was due to the challenges of paying off their medical bills. With critical care insurance, they could pay off their debt and maintain their lifestyle. Critical care insurance, let's take a look at it. It's ideal for individuals who are not covered by individual disability. Perhaps they're maxed out on individual disability coverage and group. It's a nice overlay for long-term care insurance and disability insurance. And by that I mean with both of these two products, you have an elimination period or a waiting period that you have to cover. With critical care, you could help get through those elimination periods. Sorry. If your client is self-employed and working from home, these types of individuals are hard to insure. An example would be consultants. The reason they're hard to insure is because being self-employed, there's no eyes and ears on these types of people to see how much they're actually working and how productive they are. There are individuals who have an income that is erratic, let's say real estate agents. So depending upon what's going on in the industry, their income can fluctuate, and critical care is a nice answer for that. Or no income to replace. Critical care is available to, in this situation, Sally, so it's great for wonderful non-working spouse. So let's take a little deeper look at Sally, and we're going to use her as an example for some critical care. So Sally's age 45, the same as Sam. She's non-working. And what I did here is I just took a $100,000 benefit and I took a $200,000 benefit. And I tried to show what the annual premium would be for a period of 15, 20, or 30 years. Keep in mind that that's the length of this plan, and this is how long the actual premium has to be paid. And you can see for yourself that a plan that's, for 15 years is $1,300, and if you double the years, it only goes to $1,395. On a $200,000 plan, a 15-year plan is $2,030, and if you double that to 30 years, it's a little over $2,200. There's no restriction on what your client can use these benefits for. So let's go into a little greater detail and use Sally as our example. Unfortunately, in Sally's case, she was diagnosed with breast cancer. The average age for a critical care claim is 42, so with her being 45, she's right in the middle of the national average. And additionally, hereditary breast cancer accounts for 5 to 10% of all breast cancers. So Sally purchased this coverage because of her family history. And the family protection allows her to add her husband and her children to the policy, which means she can take temporary time off if one of them is diagnosed with a critical illness. Keep in mind that with critical care, there is no waiting period that needs to be satisfied, such as in disability or long-term care. As soon as the diagnosis is made and is submitted to the insurance company, they are eligible for the benefits. And some examples of what those benefits can be used for are experimental treatment or drugs, co-payments and deductibles, credit cards, child care, like we talked about with Sam's concern. If your client has suffered a serious injury, if there's modifications that need to be made to the home, such as a ramp or modify the bathrooms. If you're, in her case, she's a teacher, but if she could no longer teach and she needed to learn a different occupation, it could help pay for that. And if, let's say, her breast cancer treatment had to occur out of town, they would provide for, this money could provide for lodging and transportation out of town. As a further note, if this particular purchase is made, there is a survivor benefit, and the survivor benefit means that if Sally dies from a covered illness, her beneficiary will receive any benefits not paid. In addition, there is a return of premium rider that would allow a return of all the premiums that Sally pays if she dies from a non-covered condition. So here's some examples of what critical care insurance will cover. Obviously the biggest ones that we see are cancer or a heart attack, but you can see it'll cover things such as long-term care with advanced Alzheimer's disease. Another one that we'll see is end-stage renal failure or paralysis. So at this time, I'm going to turn it over to Keith, who's going to talk to you about group life.
Thank you, Kathy. We're switching chairs here, so just give me a chance to get here. So group life, just want to say one thing to Kathy. Happy birthday! She didn't know that was coming. Today's Kathy's birthday, so I'm sure all of you were out there cheering and playing and singing happy birthday too, so happy birthday, Kathy. Okay, group life. I'm going to sort of take Sam back in his business life. I'm not going to change his age, but for a moment in time, Sam didn't buy the business yet. He's still working for a company, but he just got a great promotion and a big raise. So Sam was offered the opportunity to buy an additional $250,000 of group supplemental life. I need to define that a little bit. There is the group life that the employer pays for, which is always a good deal, let the employer pay for it. But in this situation, many times group life also offers the person to buy additional insurance if they like to do it. And in his situation, he got a big enough raise, he was offered $250,000 more, and his premium was going to be, for this $250,000, $17.92 per paycheck. That doesn't sound like much, but he was paid twice per month, so we'll get to how much it really costs after a while. But what happened was he came to you, He said, you know, when we started this, I've been with you a while, and you told me I should take the group life before because it was a good deal. Well, I'm getting a little older now, and so his question is group life a good deal after age 45? Well, as Kathy talked about, there's difference in underwriting, so let's talk about group life versus individual life. For group life, most of the time it's guaranteed issue. It's a large enough firm, large enough company, or at least simplified issue, meaning you have to answer usually about 5 questions. And it's either male, female, tobacco, or non-tobacco. So there's basically just 4 rates. With individuals, obviously you need, not obviously, but you do need an insurance exam. And they will give multiple underwriting classes, which includes the super preferred, but also includes ratings, which group life, if you answer certain questions, if it's simplified issue, and you answer some of them no or yes, whichever is the wrong answer, you can be declined. So it's basically 1 rate for group, and there is multiple rates for individuals. What's the premium? Well, group life is very competitive when you're under age 45, and we'll go to real numbers here in a second. But 45 is sort of the magical number in the insurance world. If you are healthy, actually individuals are best. Individual insurance is best after age 45. Are the rates guaranteed? Well, no. For group life, they're not guaranteed. As a matter of fact, they will always go up in quinquennial ages. I love that word. I just love quinquennial. Wish I could use it every day. Quinquennial means that your age is either ends in a 0 or a 5. So every time you have an age that ends in like in situation, he's now 45, his rates will go up from what he paid when he was 44. But when he was 44, he paid the same rate when he was 43, 42, 41. So it goes up. But not only are they not guaranteed, but yet they will go up every 5 years. Even the plan's not guaranteed, because if the employer chooses to say, I don't want group life anymore, you have nothing to say about it, they just go on. For the individual, the rates are guaranteed for the duration of the term period. At least any quotes that you'll get from LLIS, they are guaranteed. So what I mean by that, if it's a 20-year term, the premiums are guaranteed for the full 20 years. If it's a 30-year term, it's for the full 30 years. So the rates are guaranteed for the full duration. What about the death benefit amount? Well, with group life, it's usually based on formula, which is usually based on the percent of salary. If you need a lot more, tough. If you don't have a big enough salary, you can't buy any more, no matter what. An individual is based on the amount needed, so that's usually a pretty good deal. Convertibility, well, maybe. Group sometimes is convertible, but it's usually not to a very competitive product. And there's logic behind that is because this person has never been underwritten. And so it wasn't underwritten when the term took place, and now not being underwritten when the permits take place. So the life insurance companies know that the only people who are going to probably convert their group life are people who can't get it outside on an individual basis, so they're going to probably sock it to you pretty well. On the individual side, most are convertible for the term period, meaning if you have a 20-year term, it's convertible for the full 20 years. There is an age at which that usually stops, and that depends upon the carrier. It could be 65, 70, or 75. So even though your premiums may be guaranteed past age 65, for example, in some companies, your convertibility may stop at that point. Portability, obviously, is not on group unless you convert it. On an individual, yes, it is, because it's yours all the way. So that's the pros and cons of group life versus individual life. But what about the price? Well, this is the annual premium now, not the per month. If you multiply that, by the way, times 24, you would get these numbers. But so at age 35 to 39, for $250,000, it's $150. Not a bad deal. When he was 44, it was only $250. But now that he's turned 45, that $250,000 is going to be $430. So I don't have to go back and forth. We're going to say when he was 44, $250,000 was $250. But today it's $430 because he just turned 45. Okay, what about an individual policy? Well, let's focus in on age 40. When he was 40 to 44, remember his premium was $250. Well, a 40-year-old to buy 25 guaranteed level was $380, even if he's super preferred. And most people will say that's more expensive, so group insurance is obviously better. Well, it does go up every quinquennial age, and it's not obviously better, but for the next 5 years it is better. So that's why we say people under age 45 probably will take to the group term because they look at it a year at a time. But now that he's age 45, if he's super preferred, it's $333. If he just preferred, it's $390. Remember, group insurance for just 5 years is going to cost him $430. So in this situation, is it a good deal or not, group insurance after age 45? Well, what he did, due to your advice, he turned down the supplemental group. Why? Because for the 5 years to age 45 to 49, it was going to cost him $430. Then it was going to jump up when he turned 50, as quinquennial age. It jumped up to $630 for the next 5 years. Then it went to $1,188 for the next 5 years, and then to age 60 and 64, it was $1,734. Instead, he got preferred, not preferred plus. He got a guaranteed level, $395 annually. So thanks to you and your great advice, the total savings over 20 years is $12,010. So your advice to them was, don't take the group supplemental term. We'll get it through an individual policy. I hear the crowd goes wild. Okay, key person. I want to say this simply, and I'll say this again for buy-sell in certain situations, is that a key person on an individual company, if you're a sole proprietor, you are the key person, but you really can't buy key person insurance because the death benefit doesn't go to anybody because you are the company. If you die, so does the company. So key person and buy-sells are for people who have more than one-person companies, as Sam does. So who is a key person? Well, usually they can be the owners. And you say, well, that's obvious. Well, it's not obvious because many times there are owners outside the business. They may be key to, you have to pay them back or to loans or whatever, but they're not key in making the company really run. If the owner dies, the owner's wife or the owner's partner or whatever, now is your, the owner of the company. You don't care. So, but if it's you or other owners of the company, many times those are the key people. It would also be those who are the decision-making people, who may or may not be owners, many times they're not, is if they have the position that they can make decisions for your company, then they would be considered as a key person. There are some that are in critical positions, such as maybe a scientist, maybe somebody who does formulas for gasoline for high-powered cars. Who knows? Things that they do that's unique to them, not necessarily because of anything other than just what they do in the flow of the business. And then those are the special talents. Many times special talents are your salespeople who can just either recruit people for you or go out and sell things. They just have a natural ability to sell. But they're not an owner. They're not making decisions, but they have special skills that makes your company work. So what's the value of a key person? By the way, just because you say it's a key person, the owners of the key person, you can't just have an unlimited amount of insurance on them. There has to be some justification for the amount of insurance you would put on a key person. Most of the time there's a multiple of compensation. The insurance companies say that, well, based on your compensation, that's how valuable you are to the company. So it makes sense that it can be, depends upon age and that kind of stuff. It can be from 10 to 15 times their compensation is justifiable. The one I like the best, but it's probably the hardest to actually define, is how much do they can actually contribute to the profits of the company. It may or may not be in the same proportion as compensation. And then there's the cost of replacement. Any three of those can be used to justify how much insurance you have on a key person. How does it work? Well, the corporation is the owner, is the payer, and the beneficiary of the life insurance. Premiums are not deductible. The death benefit is income tax-free to the business. So it's a non-deductible expense, but if a person dies, it goes back to the corporation, because it's what we're insuring is basically the contribution that this person is making to the profits, to the making and running of the corporation. It is not an income replacement. It's not for the employee or the employee's benefit at all. It's for the corporation's benefit. And what kind of life insurance should you have? Should it be term or permanent? Well, there's advantages of both. Term insurance is just, you die, we pay. It's for death only. It is, it's the lowest ongoing premium, and many times, like in this situation for Sam, he's 45 years old, he just bought a company, probably he's going to look to the term insurance if he's going to do anything for key person insurance. But it is the lowest premium. One problem of it is there's no recovery of the cost of the employee leave. So if you have turnover, if you have it on a key person and they leave, you've paid premiums for 3, 4, 5, 10, 15 years, and they leave, it's just money that you spend on term insurance. And for term insurance, there's really no real benefit to the employee. The exception, and this is the reason I mentioned this exception, because it happens to be one that we've done with a financial planning organization, who the individual did retire and his health had changed, and the firm gave him, because they didn't want the term insurance anymore, they gave him the policy which allowed him to convert it to a very competitive permanent insurance. So that's a very thin thread of any advantage to the employee. I'm going to pause here for a second to tell sort of a story, a real life story, that if you are working with your client who happens to be the owner of this business, and in this situation, the business was a shampoo, cosmetic type of company, and this young man was the one that was actually running the business. He didn't own the business, had no ownership, had no management skills for people, but he knew how to get the supplies in and out, and with very little inventory, and when he came on board, the profits just soared because they had very little inventory, but yet they fulfilled all the needs of all their clients. So he just came into the place. Well, it was determined this was a key person to the quality of the company and to the profits. And so the advisor and the business owner decided that they were going to put a $500,000 policy on his life. But they really didn't tell him much about it, other than when LLIS gave him a call and said, you're a key person of the company, and they're buying a $500,000 policy on you. And he sort of said, no. If I'm worth $500,000 to this company, why is my salary not that amount? He just didn't understand. And it took almost 18 months before we actually ever got any insurance on this individual, simply because, well, he was a key person. There's no doubt about it. The insurance company accepted it. Everything was fine, except they forgot to tell him. And he says, what benefit is it to me? So there is that. When you look to key person insurance, make sure that the person who's being insured understands what's happening and why it's being done. Should you use permanent insurance? Well, in this situation, I'm going to reply only if it's no load. Permanent insurance, no load, has no agent's commissions, has no surrender charges, has high immediate cash surrender values. If it doesn't have those kind of features, then most likely I probably wouldn't recommend permanent insurance for key person. But with high immediate cash values, in the situation where you pay a premium at the end of the first year, the first month, you're going to have 90% or 85 or 101% of the cash surrender value. So if the employee leaves, then you get your money back, and maybe a little bit of profit or excess. The values accrue inside the policy on a tax-deferred basis. There are no retained earnings problem. This is a true statement. It really probably doesn't apply when it's only key person, unless that key person happens to be you or happens to be the owner, and they're also using it to put funds away for a pre-retirement plan or a retirement plan. And then you have sometimes retained earnings because you can't put in anything else. And the value to the employee maybe, a member of the employee may be the owner, maybe the person making the decision, that with permanent insurance and cash value inside of a NOVA policy, you may be able to change that key person then to a salary continuation plan at retirement. So more complicated than we probably can, than we do have time to talk about today, but if any of those strike a nerve, you can give me a call sometime when we talk about how that can happen. So, okay. Finally, we're going to talk about buy-sells. You've created this business. You put blood, sweat, and tears into it. It's the biggest asset you have, as Kathy was talking about. Now the business is generating income for not only you, but very many other people. But how do you get your money out? Well, most of the time it's done via buy-sell. Generally, what is buy-sell? Buy-sell means that there's an agreement between the owner of the company and someone else, maybe another owner or maybe somebody outside there, but someone else, and it's a written agreement that says, I, the owner, must sell, and you, the person who's going to buy, must buy at some event. And in this situation, since I'm talking about life insurance, that event would be a death, and we will have a settled upon price of what that is, either a formula or a price. Now, I'm going to talk about life insurance on a buy-sell, and Kathy could have it, I just didn't give her enough time, and those of you who want to can give her a call. You can also do buy-sell if the trigger point is disability. Many times the disability is 1 year, I believe. If you're disabled 1 year, then you can get a lump sum, or the company can get a lump sum, depending on how you set it up, that you can actually use to buy out the partner. So I'm going to talk about death, and I'm not going to talk anymore about the disability buyout, but there is that product, and you may want to look into that as well. So how does it work? Well, to get the value out of your company, you build it up. You say it's worth X amount, and it may or may not be, but we'll talk about that in a second. But the first thing you need is a buyer. Well, of course you need a buyer, but sometimes that's not the most obvious thing. Who is that buyer? In small firms, many times the person who is, the up-and-comer, the one that's doing a lot more work, you feel good about this person, they may say, why would I buy it? If you die, I'll just take it over, and all the clients that come with me anyway don't need to buy it. So, make sure you know who the buyer is and the buyer understands that this is what's going to happen. You need to agree upon the value. The owner always thinks it's more valuable than the buyer, but agree upon it, or a formula. You need an agreement, actual written agreement. That's the key to this, and then you need the funding. So let's talk about the funding just for a second. The funding, you can obviously do it by just building a cash reserve. The problem with that one is you need time. You're not going to have it all build up in a very short period of time. It takes many, many years usually. You can borrow the funds, that's true, but who do you borrow it from, and at what interest rate, and are they willing to borrow the funds, loan the funds to you if the owner just died? And not only now do you have to pay interest on that, you have to prepay the principal, so it may be a burden on that. You can spread out the payments from future earnings. That seems to be the most popular one, but usually the seller doesn't really like that idea because they usually think, well, the reason this company has been so profitable is because of me. I'm not there. How much future earnings are there going to be out of this thing? And they may just run into the ground, and so my beneficiary doesn't get anything out of it anyway. And finally, there's, surprise, surprise, insurance. Well, why does life insurance work well, in my opinion? Well, first of all, you pay as you go. You get the full amount of early death. You can pay one premium and the person dies, you get the full amount. Remember, cash reserves, it took time to build up. There's a no retained earnings problem. We've already talked about that. And tax advantages, the life insurance comes in income tax free. When you buy out the estate gets stepped up in cost basis, so there's no capital gains in the buyout. So it all sort of works pretty well for funding with life insurance. There's two ways to set up a buy-sell. There is the what's called an entity purchase or stock redemption. In that situation, the corporation owns and buys and owns the policy, and then when the person dies, they get the death benefit, they buy the shares from the estate, and they retire the shares. Therefore, the remaining shares are still in proportion. Let me explain for a second. let's say the owner who died owned 90%. You have one other person who owns 5% and another person who owns 5%. Well, when they buy the shares and 90 retires, if there's only 10 shares left and they're both owned equally 5 by one, 5 by another, so now you have 2 owners or 50-50. You can work out the math on the other ones. Probably the most popular is this one. It's simple. It's one policy on one person that goes to the corporation, retires the shares. But again, it doesn't work for a sole proprietor. You need a second person who has at least one share for stock redemption to work. The other is cross-purchase. Now, this simply is if you have owners A and B, A owns a policy on B, B owns a policy on A. If they don't own policies, A has some money that he'll give to B state and vice versa. So you use your own money, but usually it's funded with life insurance. The insurance company can bonus the premiums to each other. And this works pretty well as long as there's 2. After you get more than 2 owners, it really gets complicated. Here we have 3. That shouldn't be too bad. We have A, B, and C. So what do we have? A has to own a policy on B and C, so that's 2 policies. C has to own a policy on A and B, that's policy 3 and 4, and C owns a policy on A and B. So you have 6 policies for 3 people. I was going to have a quiz, but I don't have enough time, so I'll just go to the next slide. If you have 4 people, you need 12 policies. If you have 5 people, you need 20 policies. So you can see very quickly that cross-purchase does not work very well when you have more than 2. Sometimes 3 isn't too bad with 6 policies, but after that, it's just stock redemption really is the way to go. So what have we covered? Other than the fact that we're running out of time, and I wanted to save a little more for questions. Kathy talked about the business owners for the clients, where you protect the business and the business overhead so there's money to keep the doors open. How to continue to fund the retirement income when you become disabled. Critical care for those who either maxed out or spouses or those who have no income. It's a new product, and you haven't heard much about it, too much probably, but it has a lot of applications that we tend to ignore because we think they can't get anything. We talked about life insurance, group life versus individual life. We talked about key person, and we talked about getting your money out of your business, but to buy, sell. I talked about life, but again, Kathy could have done. Now, just a quick, did you know, for those of you who have never been to an academy or haven't been there for a while and want to come back, our new 2014 academy has been dates have been set. It'll be in February here in Tampa. You can register if you like. For those of you who are Garrett members, Judith and I will be at your retreat in July. And of the things that we talked about today, there are a lot of advisor tools out on our website. Talks about critical care, talks about key person, and talks about buy, sell, talks about other business solutions, the taxes, who owns what, how's it taxed, and all that kind of stuff. So there's a lot of tools out on our website as well. And one quick plug, next month's webinar will be for people in their 50s and 60s. Focusing on long-term care and hybrids, and then in August we'll get into the part 2 of the 50s and 60s, and then you can see the rest. So, don't need to know about that. You already know about that. You don't need to know about that. You've seen all that kind of stuff, and there we are. And I've got about 2 minutes for questions. Kathy, could I answer this one in just a second?
I have a question. Is critical care a good alternative for long-term care? And yes, critical care is a situation where if you have a loss of independent living, which is the activities of daily living, bathing, dressing, toileting, transferring, you can be eligible to collect a benefit from critical care. Additionally, loss of independent living is covered for the life of the policy at 100% after they satisfy 180-day elimination period. We have another question. What does critical care underwriting entail? It's the same as practically disability insurance. They do have to undergo an exam. The benefits can go anywhere from $10,000 to $500,000. They will be fully underwritten, similar to life insurance, similar to disability insurance. And I'm going to turn it over to Keith for our next question.
We had a question on term insurance. Can it be reduced? Technically, that's well, more technically, it's by contract. It's up to the insurance companies to allow that. They do not need to. Most of them will allow you to do it one time, but the premiums are not proportional because you probably dropped through a band. The question was, if I go from $1 million to 500,000, can I do that, and would the premiums drop proportionally? The premiums will drop, but it will be based on what the band is for the 500,000 instead of $1 million. So it'll drop, but not totally proportional. But the insurance companies do not need to allow that. Most of them will usually allow you to do it one time, but if you try to drop it every year, they just pretty much say no. How do we begin the process? There's a question of, how do you work with us when we have business clients? Probably in that situation, I'm Keith or Mark. Give us a call and just talk to us. What are you, what is the client concerned about? Is it a buy sell? Is it if it's you yourself? Talk to us. Just give us the situation. We'll need to know, is it a C corp, an S corp, a sole proprietor? What are you trying to accomplish? That kind of stuff. So how to work with us is a good old-fashioned way. Talk. Just give us a call, and we'll be glad to visit with you. And then we have a lot of backup material that we can give to you that you can give to your client as well, so that it answers probably 99% of the questions. And who owns it, what's deductible, what's the tax ramifications, all that kind of stuff. We have all that material, but I say most of you just give us a call. Well, I see it is 5 o'clock. If there's any questions that have come in that we haven't answered, we will respond to all of them via email to you directly. I want to thank you all for attending and listening to us, and we also thank you for your business and your support. Many of you, I hope to see you in Kansas City in July. And other than that, we will age these people, and they'll be in their 50s and 60s next month. Thank you very much. I guess we'll say goodbye.